If you're a homeowner, APRA has your back. Let's have a look. Hello everyone, Florian here and welcome to a late night episode of HeiseSays. And, well, honestly, grab your ice cold rum. You're going to need it for this one, guys. Oh, that's good. It's really hot at the moment. I've only got a fan, no aircon, but an ice cold rum, oh, it hits the spot. Now, this is an interesting one, guys, because, well, we're all aware of the property sector here in Australia. It's the state religion. The government uses housing to stimulate the economy. There's TV shows left, right, and centre where they bullshit you into thinking you can do up a dump in 5 minutes. And everyone just needs to work at Macca's and you can have a property empire by the time you're 30. That's how it is in Australia. Now, we're property obsessed. A significant portion of Australia's wealth has been diverted into the property and housing sector. And frankly, I don't blame people for doing it. It makes a lot of sense. When you look at the bullshit you have to go through to start a business, all the people you have to deal with, all the government hoops you have to jump through, and then you look at buying a house, negative gearing it, sitting on it and seeing how much it goes up in capital, can you blame people? Is it fair? Is it reasonable? Is it the best thing to do for our country in the long term? That doesn't matter. People don't care about that. What about housing affordability for younger generations? Nah, it's all talk. It is all talk. Government will juice up the housing market again and again. And, well, they're not alone in their mission. They're not alone. So this is an article from Australian Broker. APRA open to changing banking rules for home loans. Okay? APRA are open to changing banking rules for home loans. I'm going to have a shot of rum because I need it. Just dwell on that. You all know, the regulars, how frustrated I am when they change the rules for allowing businesses to trade while insolvent. And we're seeing the consequences of that play out now as builders go bust. Historic factors. So let's look. The chair of APRA has revealed he is open to changing bank rules on home loans if the Australian economy deteriorates, ensuring banks do not choke off credit and upset house prices further. Okay? Let's just read that one again, and we'll highlight it in red. The chair of APRA is open to changing bank rules on home loans if the Australian economy deteriorates, ensuring banks do not choke off credit and upset house prices further. There you go. So, I mean, here's the thing, guys. If you're expecting a huge correction in the market and housing to become affordable like it was back in the day, well, you're fighting the system, aren't you? You're fighting the system. They'll change the rules. They'll change the rules. So all your predictions, all your assumptions, out the window. The Australian Prudential Regulation Authority Chairman, John Lonsdale, pictured above, told the Australian Financial Review on Tuesday he was confident that banks had sufficient capital buffers to withstand falls in house prices, as economists predict home prices could fall 20% from their peak amid rising interest rates. Now, let's just bring up this little chart from SQM looking at the capital cities while we're all freaking out about housing. Let me reload that. Well, there you go. Okay, what are we at now? Wait, let me full screen it so I can see it there. Yes, so we're 1.2, so, we dropped 20%, say 200,000, we're down here. Okay, we're back to 2021 prices. Back in the good old days, guys. You know when housing was affordable in 2021? Yeah, I don't know. I don't remember either. So that's something to keep in mind, guys. If we lose 20%, it's not going to be that epic correction people are hoping for. We watch housing very, very closely as it affects the banks we regulate, and it is very important in the Australian economy. Yeah, we don't have a free market. Australia does not have a free market. We're a regulated economy. I don't think the average Aussie would even be able to... They wouldn't want a free market, honestly. They are not up for that excitement. They want nice, boring stability, and I can't blame them. So, Although this is getting bloody expensive, guys. I went to the Bottle-O. We were naughty today. We took the kids out swimming, and so we got pizza on the way home. I'm taking a bit of a naughty break from the diet occasionally because, you know, homeschooling kids, we want them to have a normal life. And even the pizzas have gone up. They're up like $6 now for the cheap ones. The add-ons are up 25 cents. Used to be $2 for pineapple, now $2.25. There you go, guys. It's getting more expensive. Anyway, this year will be challenging, but we've done a lot of work over a long period of time to make sure the banks and the system is safe and stable, and we have a safe and stable financial system. Okay, I mean, that's fine. I'm not worried at all about the banks. Anyone that tells you they're worried about the banks collapsing here in Australia and bail-ins, they're just telling you that to manipulate you for political purposes. It's not a risk in Australia. Okay, they will happily chuck future generations under the bus to keep the big four going. Okay, don't worry about it, guys. Look at Pyramid. Look at what happened there. So economists are predicting another increase in the official cash rate when the RBA meets on Feb 7, with another lift in March before pausing ahead of a possible final rate increase by mid-year. 2 more hikes could push the 3.1 cash rate to 3.85, a level not reached since 2022. Are we at 3.1? I think we're 3.35 already. Maybe this article is a bit older. But that doesn't mean this isn't something we should be worried about. The fact that they're even saying this, that they're willing to change the rules. Wow. Meanwhile, capital city house prices are expected to fall over the first half of the year after recording an 8.4% decline in 22, according to CoreLogic. Yeah, but it's off. It's coming down, but it was overinflated due to FOMO and COVID hysteria, really. Lockdown hysteria. Craziness. The only thing is we need to make sure the property bros don't realize lockdowns force people to save, because then you start having deposit lockdowns. Oh, boy. Lonsdale said capital levels build up by the banks since the financial system inquiry and the ongoing focus on lending standards would allow banks to cope with a fall of this magnitude. We have built a very strong capital framework that provides a lot of buffer in the system. At the heart of it is the unquestionably strong reforms which we are embedding, he said. Second is pursuing very sound lending standards. And we've been doing that for a few years. If you look at Prudential metrics right now, they look very good. We have strong capital, strong liquidity, and credit standards are very good. So we sail into 2023 in a good position from a system point of view and entity point of view. So here's a question to you. Since we have this regulator in place to ensure that banking is stable and strong and secure, and we can trust the system, is that creating a situation where there is an incentive for them to intervene to ensure we don't get a significant enough housing correction to put these banks at risk? So based on that, because we have this is all artificial third-party regulation, and people want this, they call for this, they expect this here in Australia. Is this another argument against housing ever reaching an affordable level here? Always keeping it inflated. Because we'll always have intervention here. We'll always have changing at the rules when anything looks a bit dangerous or the economy is starting to correct. I wouldn't be shocked. And don't worry, this is only my third rum for the night. This is a late night recording. I was going to sit down and play some Battletech and just chill, relax. So serviceability and ongoing concern. Lonsdale told the Australian Financial Review he was comfortable with current controls on bank lending for housing, but if the economy deteriorated, it would be open to changing the macroprudential policies to ensure banks did not choke off credit, which could exacerbate house price falls. APRA's macroprudential settings, including the serviceability buffer, requires banks to assess new loans at a rate 3% higher than the current market rates. Lonsdale said the regulator would consider readjusting its rules to respond to lower credit growth or house prices, which would ensure credit continued to flow in the face of more aggressive official rate rises to reduce inflation and billions of dollars of fixed-rate mortgages reverting to much higher variable rates. We think the macroprudential settings, including the serviceability buffer, which is just one of them, are appropriate, he said. But if facts change, our views might change too. Mid-2019, APRA lifted its serviceability buffer, which banks apply to ensure customers can cope with future rate rises from 2 to 2.5% and then 3% in October 21. The RBA has raised rates by exactly this amount since May. In its report, Lonsdale told the AFR that the markets now expect that following a few more cash rate rises, the Reserve Bank could start easing rates early in 24, while any reconsideration of the serviceability buffer would show APRA was also preparing for rates to peak. It is very much a trade-off, as their main focus is protecting bank depositors by ensuring lending standards are strong, he said. We knew things were going to become more difficult when we increased the buffer in 21, but at the same time, we've got to balance not choking off credit. There is a difficult balance that needs to be struck. So credit growth under the microscope. So, oh boy. Are you surprised, guys? Are you surprised? It's a good rum. I'm drinking the Lazy Bear, the rum and dry with the lime in it. Nice. Drink responsible. By the way, I'm not driving. I'm walking home. It's all good. So, APRA's latest set of property exposure statistics found the serviceability buffer fell below 3% in quarter 2 and quarter 3 2022, the AFR reported. The statistics showed the implied buffer was 2.7% in quarter 3, down from 2.9 in 2. These numbers do not include fixed-rate loans. Going forward, we will look closely at credit growth, asset prices, whether housing or other asset prices, and we always look closely at lending standards. They are the kind of key indicators that we will look at during 2023 to see whether there are any changes necessary. Lonsdale said, with a slowing economy and house prices falling, there would be stresses. But the system is strong, it is resilient, and can stand up to stresses. We stress test the banks, they remain sound even under stringent stress testing, he said. There will be some people who suffer stress, and that is very unfortunate. This is the Australian way. This is our nation and our culture. You know, the least amount of suffering for the greatest good. They want to have all these mechanisms in place to assure there'll be some people that suffers, there'll be some people that won't be able to afford housing, but for the greater good to maintain the stability, so you won't get the corrections. That's our culture here. We're not like America. But what we are saying to the banks is they need to get onto this early. They know which customers are likely to be affected, and if you have more time, you can get a better outcome. So there you go, guys. There you go. And this came out at the beginning of the month before that rate increase that we saw. I just discovered this one tonight on Twitter. So let's have a talk about this one. Well, what do you reckon? Are you at all surprised that APRA might change the rules? I'm not at all. We saw what ASIC did. We saw what the government did. It's the Australian way, guys. Here's another argument supporting house prices. Is it fair? Is it reasonable? This is what people want. This is the Australian way, guys. I can't see housing crashing and becoming more affordable. I can see more government intervention, more shared equity, and, well, the individual homeowner and the renter becoming a greater divide. We're gonna have a class divide here in Australia. You got to get on the ladder, guys, and you got to not let go, because it's just going to get bloody harder, more and more. Anyway, thanks for watching. Like, share, subscribe. Check out my other channels, Heise BIM and Heise Does. And if you're a fan and want to support us, you can on YouTube or Patreon. Use our referral links, buy our merch, or call us if you need an architect, guys. Take care. Have a great night. I'm going to, finish off this rum and then go play some computer games and relax for tonight. Have a great day, and I'll see you next episode. Oh, that's good. See, that's the sponsorship I'd want, you know? Not all these bullshit mobile games. Why are they emailing?